Hi everyone, this is Paul Tilley and welcome to TB 1040 Financial Management. Today we're looking at Unit 4, Manage Cash Flow, and this is part 1 of a two-part video.
This is, I won't call it a heavy topic, but it's a topic that you're probably not familiar with, because even bringing in the issue of a balance sheet and an income statement that we talked about in the very first night was a little bit challenging if you're not familiar with those things, okay? The balance sheet is designed to get a snapshot of how the business is, how much it owns, its assets, and how much it owes, liabilities and owner's equity. The income statement is a measuring tool to say how much money you made during the year and how much money you spent during the year, or how much, I shouldn't say money, I should say how much revenue earned and how much expenses you incurred. Because the silly thing is with those statements, or not the silly thing, the proper thing with them, is they're not based on necessarily real numbers. Take it, for example, in an income statement, let's assume you go out and do a job for someone and you make $100 on that job, okay? That's your revenue on that job. You send a bill to them and they pay you, let's just say they're going to pay you next month. You're going to recognize what in accounting, you recognize the revenue right away, meaning that you record the fact that you made $100. The reality is, though, you do not have $100 in your pocket because you haven't got paid for it yet. So you're recognizing the $100 in one breath, but you don't have the money in the other breath. So in business, cash is king. You got to pay your bills. You know, it's one thing for payday to come and you got to pay your employees and you don't have any money, right? So that's a bit of a challenge. So the way financial statements are set up and the way the business needs to run, in other words, we need to know how much money we have. The financial statements are just really giving us an idea of inflows and outflows in terms of it will get paid or money will come in eventually or money will go out eventually. There's a little bit of a disconnect in the statements. And this disconnect really only shows up if you come to the end of the period, like you're running your financial statements from the beginning of the year to the end of the year. But what if something falls over the year? So let's say, for example, you did that $100 job for someone. Your year end is coming up right here. You're not going to get paid until this point down here. You're going to reflect someone owes you money. In your financial statements is going to be what's called an accounts receivable. Someone's going to owe you money, but you don't have the cash and you got to pay the bills. And, you know, your banker's going to look at you and say, well, you know, you got bills to pay. Where's the cash? So what we really need to be able to do is take a particularly hard look when we think about in a small business at cash and what are we using our cash for? When is it coming in? Where is it going to? And that way we got a little bit of better control over our overall structure of the business and knowing that we got enough money to pay our bills and we got enough money to buy things and, you know, things will continue in the business. So the accounting industry has come up with another statement. So we got the balance sheet, the income statement, and the accounting industry has come up with another statement called the cash flow statement. Statement of changes in cash position is often called. But it tells us in our statements at the end of the year, it tells us what our cash, where our cash came from and where our cash went. So if an investor is looking at our statements or if we're looking at our statements, we have a good idea of what we did with all our money, what we did with it, and where it came from when it comes in. And that will give us an idea how much actual dollars and cents we have to pay the bills. So that's what this particular section is about. Tonight, we're going to look at this thing called the cash flow statement. Next week, we're going to look at using cash flow to plan a business, okay? So this is kind of reactive. This is like we've got the statement. We had to understand what the statement means. Next week, we're going to look at how can we use this type of information in order to predict how much money we're going to have coming in or how much money we're going to have to go out. So it's a kind of a forward-looking next week. backwards looking tonight. So tonight we're looking at this part one, conduct the cash flow analysis, okay? And we'll look at this concept of cash flows next week. So cash flow is a terminology that really looks at the movement of dollars and cents, funds, within and without of a business. So money coming in, money going out. I always analogize it to a bathtub, okay? Your taps are up the top, you turn on the water, water goes into the bathtub. Now, if you put the plug in the bathtub bathtub will fill up, like your bank account will fill up. Now, as you take the plug out of your bathtub, even though there's water still going in, if it's going out faster than it's coming in, the tub will eventually drain out. The opposite could also be true. If the money or the water, in the case of the bathtub analogy, if the money or water is going in faster than it's coming out the drain, your tub will rise and eventually overflow. We like that in business with regards to money. We do like more money coming in than money going out because our coffers will rise up. The problem area lies when we say, okay, we're spending money faster than it's coming in. That's going to lead to some problems. And this is where we run into, sometimes you hear companies into a cash flow crunch. And all that means is they're spending money, money's going out faster than it's coming in. The bathtub is drained. So cash flow can be described as being positive or negative, as I just spoke about. Positive means there's more coming in than going out. Negative means there's more going out than coming in. Positive cash flows occur when the cash coming into the business from sales, accounts receivable, etc., are at a greater rate than what's going out of the business in terms of accounts payable, monthly expenses, and salaries. So this is expenses and money going out of the business. This is revenue coming into the business. Negative cash flow occurs when the outflow is greater than incoming cash, and that could cause a little bit of a problem. So we need to recognize that when it's happening, and we need to correct it. We need to get our sales up. We need to increase our revenues. We need to decrease our expenses, something along those lines in order to maintain the level higher or going up as opposed to coming down. So by keeping up-to-date and accurate records, books I call it here, but having a good record of the cash flows allows us to identify these problems before they run into trouble. You're watching the tub go down, and then you can do something about it. Put the plug in. If you're not watching the level of the water in the tub, you have no idea if you're going to have water in the tub or not. So here's the nux of the problem, or the nux of the idea of what's going on with the cash flow statement. We have two statements here. We have year one and at the end of year one. Okay, this is the beginning of year one, and this is at the end of year one, which is the beginning of year two. Okay, at the beginning of the year, we looked at the balance sheet on December 31st, 2019, and we saw that the cash account, and I've only got that bit of the statement there. We're only interested in cash, and there's assets, liabilities, and owner's equity too, but we're only interested in cash for these purposes. There was $84,000 in our account, okay? So that was at the beginning of the year. Now, over the course of the year, we did business, we made revenue, we incurred expenses, money came in, money went out, We're going through the year, and at the end of the year, which is the beginning of the following year, there's $44,000 in the bank account. So we started off with 84, and now there's 44. So we know money went in, money went out all year. Yeah, we had this toing and froing. But in terms of the level of the bathtub, we know that the level of the bathtub has gone down. It was 84 at the beginning of the year, and it's 44 at the end of the year. What happened? Where did the $40,000 go? What did we use it on? Maybe there's a legitimate reason. But the cash flow statement is designed to tell us why. What happened to account for that difference in the amount of cash from the beginning of the period to the end of the period. So that's what we're really driving at, is why is this happening? What's going on? So the cash flow statement is designed to tell us that. So at its essence, cash flow is the net amount of cash or cash equivalents being transferred into or out of the business. So what's coming in, what's going out. The cash flow statement is similar to the income statement. Now, we think about an income statement. What an income statement does is it measures revenue coming in minus the expenses going out, will give you a profit. Well, this one here is worried about the actual cash coming in, the actual cash going out, in order to determine why the cash changed. Okay? So we're looking for real cash here, real cash. So the reason that this is so important, again, is because generally agreed upon accounting principles, in other words, the way accounting is done, recognizes revenue when it occurs as opposed to when the actual cash comes in. And it recognizes expenses when they occur as opposed to when the actual cash goes out. So there's going to be a variation in the statements. And we have to somehow come up with a way to reconcile the two. So the cash flow statement does exactly this. Here's an example of a cash flow statement. Now, the cash flow statement, just like the balance sheet, just like the income statement, has a standard format. And this is the standard format. Now, our intention with this is not to show you how to generate this. The intention is to get you to understand how to read it, okay? So you're going to be looking at these financial statements. Your accountant will do this, and he or she is going to have this thing in there, and you're going to say, what the heck is that, okay? Here's the purpose of this statement. Going back to the beginning here, I said, let's take the analogy of in the beginning of the year, there was $84,000 in the bank. At the end of the year or the beginning of the following year, there's $44,000. Why is there a $40,000 difference in the bank? What this statement does is it gives you a rationale for why this has changed. And what it does is it breaks it down into three distinct parts. And that way you can kind of identify where did your money go or where did your money come from. The three distinct parts is cash from operating activities, cash from investing activities, and cash from financing activities. So what we're doing is we're saying, where did the cash go? It went or it came in one of three types of activities. The first one, operating activities, are the normal operations of the business. So if your business is a machine shop and you're doing machining work, that revenue that comes in from that or the expenses related to that are what are called operating. And the cash relative to operations would be reflected here. So here's an example, cash from operating activities, receipts of money coming in, collections from customers, interest received. These are normal operating activities of business. Total cash receipts, $580. That's money that came in. Payments, again, from operations. Typical operations would be stuff you buy from suppliers, your employees, your interest that you would charge, or taxes that you'd have to pay. So what we have is a total of $440 in payments. So we had $580, this is thousands of dollars, so I'll just say dollars for purposes of this. $580 came in, 444 went out. So the difference between two of these, the net of these, we call it the net cash inflow, was $136. So $136,000 really. $136,000 came in operations. So if we thought about our operations and say, this is the core business, this is what we do, is that good? Yeah, that's good because our business actually generated more than went out. So we're $136,000 to the good. That's a good indicator that things are healthy. Okay, so that's from operating activities. So that doesn't account for all the cash that went out, though, because if you recall, there are other things that we may have happened too. So the other things fall into the other two potential categories. The first one is things we may have invested in. Now, investments are long-term assets that we buy. A tractor. Let's assume we buy a tractor. That tractor is going to last for a number of years. That's what's called an investment. So let's assume in our little company of ABC Excavating that we purchased a new tractor. So cash purchase of a new tractor, that would be considered an investment because it's going to last a number of years, going to generate money. It was a $634,000 tractor. So $634,000 went out. You sold the old tractor and you got $124,000 coming in. So the difference between the two was the net of the cash outflow. In other words, how much that tractor actually cost you was $510,000 to the out. We put things in brackets to indicate that it's a negative. That's what the brackets are for, money going out. So that accounts for the money that was spent on a tractor. We also have other types of money that could be dealing with financing. So we get borrow money from the bank, and you think, oh, a bunch of money comes in from the bank. What is that? That's cash coming in. Yeah. Well, that's what's considered a financing activity. So in this case, we can get financing from two basic areas. We can sell shares in the company. In other words, the owners, more people come in, pay money to own the company, or we can get money from a loan, such as what we do when we go borrow money from a bank. So in this particular instance, let's assume that we sold some shares in the business, $202,000 came in. We got a loan from the bank, $188,000 came in. We paid, money went out in terms of financing. We paid for a loan, $22,000. We paid payments on the loan. And we paid dividends, which is money that gets paid to the owners, of $34,000. So in this particular instance, we had inflows and outflows of finance activities related to financing the business. That was a total of, or a net of $334,000. Okay, so this tells us that, yeah, we did some financing there, and, we can see that we had people buy shares in the business, we got a loan, we paid down some debt, these sorts of things went out. Now, if we add those up, so 580 plus the 136,000, the net cash, the net here was 136. So we got 136,000, which is the 580 minus 444, 136. The net cash outflows was 510 from investing. So that means 136 minus 510. And the net cash inflow from financing activities was 334. 136 minus 510 plus the 334 comes to minus 40. Minus 40. In other words, we're down $40,000. Now, the cash at the beginning of the year was $84,000, as we've seen in the previous slide. Now we're looking at the cash at the end of the year is $44,000. The difference between the two, $40,000, which is exactly that. So we have explained in this statement what has happened to account for the difference between what it was at the beginning and what it was at the end. The net of operating brought in 136. The net of investing took out 510. The net of financing brought in 334, and that accounted for this $40,000 decrease. Now, is that good, bad, or indifferent? Well, we have less cash to deal with, and so that could be a problem if there's some bills coming up that we need to pay. But what did we do? We really bought a new tractor, and that tractor sucked a lot of money out of the business. There it is there. But again, if your business is an excavating business, you need a tractor in order to generate funds. So we could argue that, that tractor was a good investment. It cost us money. It will generate money into the future. It will pay dividends and generate some cash from operating activities, which will keep the business afloat. So the idea of this statement is really get a sense of why did the cash change? And again, it goes back to this basic issue of why do we have to do this? The reason we have to do this is because recognition of revenue is not matched with the actual cash coming into the business. If we go out and do a job for someone, say, for $1,000, we'll get, we did the work. We had a $1,000 invoice sent out. We're not going to get paid until later on. So right off the bat, we don't have that $1,000, but we need to recognize the fact that we've actually earned that $1,000. So this is what we do. We do what's called a journal entry, or a record of the fact that people owe us $1,000 and we've generated revenue of $1,000. The money hasn't actually come in yet. When the money comes in, we'll do another entry to reflect cash coming in and the fact that our accounts receivable has gone down by $1,000. So a cash flow statement really is intended to help us understand where our money came from, where our money went, and to rationalize this difference between the revenue recognition and the actual cash that flows into a business. We want to recognize the fact that we really need our cash levels to go up, or at least be sufficient to pay our bills. So we're looking for a positive cash flow, more money coming in than going out. That would be ideal. If we have a negative cash flow, we can't sustain a long-term negative cash flow. In other words, if we had another year like this year here, we've seen our cash decrease. If we did the exact same thing again next year, our cash would decrease again, and we'd be down to $4,000. Or, if we reduced our cash by another 40, it's at 44 now. If next year it was down to 4, we'd eventually run out of cash. We wouldn't be able to pay our bills. So for 1 year, this might be fine. We can sustain this for 1 year, but it's going to tell us, hey, we can't go spending cash as fast as that. We really should pay attention to our cash levels. And that's really what the idea of this is to be able to do some planning so that we know what we can spend our cash on and either decrease our expenses or increase our revenues in order to cover this off. So really, we really need to look at those three statements: the balance sheet, the income statement, and the cash flow statement, in order to really get the big picture of what's going on in our business. And the idea here is that we'll be able to look at those statements and generate some idea of, to answer the basic question, is our business doing well? Is it not doing well? What do we need to change? Okay, and that's really what it comes down. So cash flow tells the story of the money that enters and leaves the business, and it certainly helps tell us, will we have enough cash to pay our bills? Okay, and we're not the only ones interested in this. Accounting personnel are going to be interested in that number. Lenders are going to be interested in that number. Investors are going to be interested in that number. Employees are going to be interested in that number. That's a good number to be able to tell you, how healthy is this business? Is this business sustainable? So as I say, the cash flow statement, when we look at cash flow statements, we need to look at these three things: operating activities, investing activities, and financing activities. The statements are always set up exactly the same. They will have these three elements to them. We recognize that an operating activity is cash that's generated by normal operations of the business. We would like to see positive numbers there. In other words, more money coming in terms of revenue than going out. That would indicate our business is actually making money. In terms of investing activities, we want to think about it in terms of the cash resulting from investments. So we go and put some money aside, we generate interest, or we buy pieces of equipment, and that will really give us an indication of how much the business is actually doing in order to sustain itself in terms of buying assets or these sorts of things. And financing activity is really going to tell us, where's our money coming from? Where is this money coming from to finance the business? Is it financed from owners? Is it financed from outsiders? And if it's financed from outsiders, we got to pay the interest on that. If interest rates go up, that's a bit of a concern. If it's financed by the owners may or may not be willing to give the business some more leniency. And I would suggest the owners are the ones that will be more lenient than anyone else. So we need to be able to decipher the fact that these three elements exist. And we can kind of pinpoint receipts and payments in each of them, collections from customers, receipts of interest, dividends from investments, other operating receipts. These are what would be considered normal receipts from operations. Normal expenses from operations would be payments to suppliers. You're paying someone for the stuff you bought from them. Payments to employees, wages and salaries. Payments in interest and income tax, and other operating payments. So money coming in, money going out. That's going to be reflected in this component called the operating. From investing activities, money coming in could be sale of capital assets. So we sold a tractor, sold a building, sold some major asset of the firm. Sale of investments, we had shares in another company, we sold those shares. That's an example of sale of investment. Receipts from a loan receivable, we loaned someone money and they're paying us back now. That's what's considered very much an investing activity. In terms of payments, acquisition of capital assets, buying that tractor, purchase of investments, we buy shares in the company, or loans made to others. All of this would be considered investing. Financing activities that you would find in that statement would include selling ownership, shares, for example, borrowing money from the banks. Pretty simple, straightforward. Any money that's borrowed or coming in from investment. Financing activities, money going out, could be money taken out of the business by owners. The owners draw out their owner's equity. A buyback of ownership of shares. Sometimes companies buy back shares. And repayment of the company debt. So these statements are prepared normally by accountants, okay? It's not something that generally the owner of the business would do because, it requires a good knowledge of accounting. But what do they need to do in order to do this? So you understand basically what the accountant is doing. So to prepare a cash flow statement, they got to go through these three basic steps. They got to identify the activities. So what was it that happened in the business during the year? And they're going to put them in one of those three categories: operating, investing, or financing. They're going to determine, is it going up in cash or going down in cash? And they're going to identify the net effect of the transaction. Money coming in, money going out. They're going to do that. So you're going to get a statement similar to this here. All of these cash flow statements look the same. And you want to understand that those three elements exist: operating, investing, and financing. And you want to understand that each element can be assessed in and of itself. For example, receipts, more came in than went out. In the case of investing, a new piece of equipment was purchased. That has added to the value of the company in terms of a long-term asset. Or from a cash flow activity, we got some money from a loan and we got money from people investing in the business. That's helped drive up the overall value of dollars and cents in the company. That's a good thing. However, in this particular instance, more money went out than came in as we consider all three of those. So as a result, our bank account dropped. So we really need to contemplate these in terms of actual cash. We're going to look at those and say, where did the money go? And the cash flow really gives us a good handle on this.